In this video, we are breaking down a high win rate day trading strategy that has been proven across 100 backtests to maintain a 60% plus win rate. What makes this powerful is the simplicity. We're using just one indicator and two specific filters that anyone can add to their brokerage account today. Using the Schwab Thinkorswim platform, we will walk you through this strategy step by step. Plus, I'm giving you the code for our two filters and the entire strategy script combined for free. Stay until the end of the video to see exactly how to set it up. Understanding dollar volume. Dollar volume is a liquidity metric that represents the total monetary value of all shares traded for a specific stock over a given period, usually a single trading day. While standard volume tells you how many shares changed hands, dollar volume tells you how much actual cash moved through that security. How to calculate dollar volume? The calculation is straightforward. To find the daily dollar volume, you multiply the total number of shares traded by the price of the stock. For example, if a stock priced at $50 has a daily volume of 2 million shares, the dollar volume is 50 times 2 million equals $100 million. If you are looking for an average, like the 20-day average dollar volume, you would calculate this for each of the last 20 days and then find the mean. The significance of the $100 million threshold in active trading, $100 million in daily dollar volume is often considered the gold standard for liquidity. Crossing this threshold moves a stock from being a speculative or niche ticker into the realm of institutional-grade liquidity. 1. Ease of entry and exit. Slippage. When you are trading with size, the biggest enemy is slippage, the difference between the price you want and the price you actually get. High dollar volume. There is enough thickness in the order book to absorb large orders without moving the price against you. Low dollar volume. A large buy order can sweep the book, forcing you to pay higher and higher prices just to fill your position. 2. Institutional participation. Large hedge funds and banks generally cannot trade stocks with low dollar volume because their positions would represent too large a percentage of the daily activity. When a stock consistently clears $100 million plus, it confirms that big money is involved. This institutional presence often leads to cleaner technical moves and more reliable trend continuation. 3. Reduced manipulation risk. Stocks with very low dollar volume, often called thin stocks, are susceptible to price manipulation or extreme volatility from a single large trader. A $100 million plus daily turnover acts as a buffer, requiring massive collective effort to move the price significantly, which usually results in more stable and predictable price action for technical analysis. 4. Narrow bid-ask spreads. High dollar volume almost always results in tighter bid-ask spreads. If a stock trades 200 million a day, the spread might only be 0.01. If it only trades 1 million, the spread could be 0.05 or more, which means you are starting every trade at a larger immediate loss. Summary table. Dollar volume tiers. Tier. Daily dollar volume. Characteristics. Low liquidity. Under $10 million. High slippage, wide spreads. Dangerous for large size. Moderate, $10 million. $100 million. Tradable for retail, but requires caution with exits. High, institutional. $100 million plus. Ideal for active trading, tight spreads and high fills. Mega cap, $1 billion plus. Stream liquidity, e.g., TSLA, NVDA, SPY, virtually no slippage. For a trader focusing on the opening range, ORB, focusing on stocks with $100 million plus in projected or previous day dollar volume ensures that when the volatility hits at 9:30 a.m., you can get in and out of your $1 risk levels with precision. Average true range, ATR, and the opening range. Average true range, ATR, is a volatility indicator that measures how much an asset moves, on average, over a given period. Unlike standard measures of change, ATR accounts for gaps between trading sessions, providing a more complete picture of a stock's daily breathing room. 1. How to calculate ATR. To calculate ATR, you must first find the true range, TR, for a specific day. The TR is the greatest of the following three values. 1. Current high minus current low. 2. Current high minus previous close, absolute value. 3. Current low minus previous close, absolute value. The ATR is typically a 14-period moving average of these true range values. Daily ATR, DATR, uses daily bars to show the average move over the last 14 days. Intraday ATR uses 1-minute or 5-minute bars to show volatility within the current session. 2. Calculating daily ATR to opening range, OR. For an opening range breakout, ORB strategy, you want to know how much of the stock's daily fuel has been used up during that first 30 or 45 minutes of trading. The calculation. 1. Identify daily ATR. Look at the daily chart. Standard setting is 14 days. Let's say the ATR is $4. 2. Identify the opening range, OR. Measure the distance between the high and low of your specific window, e.g., 9:30 a.m. to 10 a.m. Let's say the OR is $1. 3. Calculate the percentage. Example, $1 per $4 times 100 equals 25%. 3. Determining if it is above range. In the morning hour, determining if a stock is above range usually refers to whether the volatility is overextended or if it has enough room left to run for a profitable trade. A. The overextended test. If the opening range itself is already a massive chunk of the daily ATR, the stock may have already made its big move for the day. Low relative volatility, OR, is less than 20% of ATR. Plenty of room for a trend to develop. Healthy volatility, OR, is 20% to 40% of ATR. Standard for a strong ORB. Overextended OR is greater than 70% of ATR. The stock has likely exhausted its average daily move. The meat of the move is gone, and you risk buying the top. B. The range projection method. You can project the daily ATR from the day's low to see where the expected high might be. 1. Take the current day low. 2. Add the daily ATR. 3. If the current price is above this level, the stock is trading above its range. It is technically overextended on a statistical basis. Why this matters for ORB trading? Using ATR prevents you from chasing a stock that has already moved $5 when its average daily move is only $4.50. Risk management. If the ATR is high, you may need a wider stop loss but a smaller share size to keep your $320 risk level constant. Profit targets. If you enter an ORB at 10 a.m. and the stock is already at 90% of its daily ATR, your odds of hitting a +2R target are statistically lower than if it had only used 30% of its ATR. This strategy creates a high probability filter by ensuring the stock has both the institutional liquidity to handle your size and enough relative volatility to make a meaningful move. By requiring the 15-minute range to be greater than half of the daily ATR, you are specifically hunting for outlier days, days where the stock is moving with significantly more intent than usual. The strategy logic, component, parameter, purpose, time frame, 15-minute chart, balances noise reduction with early entry. Cutoff time, 10:30 a.m., captures the peak institutional rebalancing volume. Dollar volume, greater than $100 million, ensures tight spreads and prevents slippage on your $320 risk. Volatility filter, OR range greater than DATR2, filters out choppy or sleepy stocks that lack momentum. ThinkScript implementation. You can use this code as a custom study or a scan in Thinkorswim. It calculates the 15-minute range and compares it to the 14-day average daily range. Def ISOR equals seconds from time, market open, greater than equals 0, and seconds till time, market close, greater than 0. Def daily ATR equals moving average, average type. Wilder's, true range, high, period equals day, close, period equals day, low, period equals day, ATR length. Track OR high and low. Varying def or high equals if seconds from time, market open equals 0, then high else if ISOR, and high greater than or high own, then high else or high. Varying def or low equals if seconds from time, market open equals 0, then low else if ISOR, and low less than or low. Constraints. Def dollar volume equals volume, period equals day. Close, period equals day. Def range size equals or high or low. Def valid volatility equals range size greater than daily ATR 2. Def valid liquidity equals dollar volume greater than 100 million. Signal. Price crosses above OR high before 10:30 a.m. Plot. Breakout equals close greater than or high and close 1. Less than equals or high and seconds till time 10:30. Greater than 0 and valid volatility and valid liquidity. Breakout set painting strategy. Painting strategy. Boolean _arrow _up. Execution tactics. 1. The volatility gap logic. Why use OR high, OR low greater than ATRs 2? If a stock usually moves $2 a day, ATR, and it moves $1.10 in the first 15 minutes, it is showing relative strength. It indicates that news or a heavy institutional imbalance is present. If the range is too small, e.g., 10 cents, the stock is likely in a procrastination phase and might just chop you out. 2. Managing the risk, $320. Since you are using a 15-minute range, the distance between your entry, OR high, and your stop, OR low, might be wide. Calculation. Shares equals $320 per OR high minus OR low. The benefit, the dollar volume filter, ensures that if you need to buy 4,000 shares of a $25 stock to meet your risk, the market can digest your order instantly. 3. The 10:30 a.m. hard stop. After 10:30 a.m., the institutional morning ends and the midday chop begins. If the crossover hasn't happened by then, the probability of a sustained trend decreases. This is a disciplined way to avoid being liquidity for larger players during the noontime lull. Integrating a VWAP, volume-weighted average price, crossover, as your stop-loss mechanism is a professional way to manage risk, especially for an opening range breakout ORB strategy. Since VWAP represents the fair value where the most volume has traded, a crossback below it for a long often signals that the institutional momentum has shifted. 1. The strategy, VWAP as a trailing stop. Instead of a static stop-loss based purely on dollars, the VWAP stop is dynamic. It moves as price and volume change throughout the morning. Long entry. Price breaks above the 15-minute OR high. Initial stop, the OR low, or a fixed $320 risk calculation. Pivot to VWAP. Once the trade moves in your favor, often at +1R, you tether your stop to the VWAP line. Exit signal. A 1-minute or 5-minute candle closes on the opposite side of VWAP. 2. Think script. Automated VWAP stop logic. You can add this to your existing code to visualize where the danger zone is. This script will highlight the bar if the price closes below VWAP after you've entered a long position. Exit signal. Price closes below VWAP after 9:45 a.m. Plot exit signal equals if seconds from time 0945 greater than 0 and close crosses below VWAP value, then 1L0. Exit signal set painting strategy. Painting strategy. Boolean _arrow _down. Exit signal set default color. Color orange. 3. Pros and cons of the VWAP cross. Pros. Cons. Institutional alignment. You are exiting when the average buyer for the day starts losing money. Late exits. In a parabolic move, VWAP can trail far behind the price, leading to larger givebacks. Reduces fakeouts. VWAP acts as a magnet. Many winning trades test VWAP and bounce. Whipsaws. On low-volume days, price can dance around VWAP, stopping you out prematurely. Objectivity. Removes the emotional urge to hold and hope when the trend breaks. Opening volatility. Between 9:30 and 10 o'clock, VWAP is highly unstable and less reliable. 4. Refining the exit. Close versus touch. The touch. Exiting the moment price touches VWAP. This protects capital but often results in getting wicked out before a stock continues its move. The close, recommended. Wait for a candle. 5 minute is safer, 1 minute is tighter, to close below VWAP. This confirms that the selling pressure is sustained. How this fits your $320 risk. If you enter an ORB at $50 with a stop at the OR low of $49.50, your position size is 640 shares. As the stock hits $51, you move your stop to VWAP. Let's say it's at $50.40. If it crosses VWAP, you exit at $50.40. Instead of a 320 loss, you walk away with a asterisk 256 profit, 40 cents by 640 shares. This break-even or better approach is how traders protect their S-Corp capital during the 10:30 a.m. transition. To increase your win rate, you want to move from trading a chart pattern to trading a market environment. By adding filters for market sentiment and confluence, you ensure that you are only taking trades where the wind is at your back. As you noted, this will significantly reduce the number of alerts, but the ones that remain will be much higher quality. 1. Market correlation, the anchor filter. Since you are trading a 15-minute ORB, the SPY, S&P 500, or QQQ, NASDAQ 100, is your most important indicator. Even a great setup can fail if the overall market is tanking or choppy. The logic: only take a long ORB if the SPY is also trading above its own VWAP or its own 15-minute opening range. Success metric: stocks that break out while the SPY is also breaking out have a significantly higher follow-through rate. ThingScript tip: use close SPY greater than VWAP SPY as a secondary Boolean filter in your scan. 2. TTM squeeze, momentum spring. The TTM squeeze is excellent for identifying when a stock is transitioning from a period of rest to a burst of energy. The logic: look for a squeeze, red dots on the midline, that occurred in the days or hours leading up to the breakout. The success filter: only take the trade if the TTM squeeze histogram is cyan, increasing momentum. This ensures you aren't buying the tail end of a move, but rather the beginning of a fresh impulse. 3. ADX, trend strength. The average directional index, ADX, tells you if there is a trend present, regardless of direction. The logic: an ADX value above 20 or 25 indicates a trending market. The filter: if the ADX is below 15, the market is in a sideways or mean reversion state. Your ORB strategy will likely get chopped up in this environment. Winning edge: combine this with DMI plus greater than DMI minus for longs to confirm buyers are in control. 4. Put/call ratio and VIX, sentiment overlays. These act as a temperature gauge for the market. The logic: asterisk VIX. If the VIX is spiking, showing fear, long ORBs are much riskier. If the VIX is trending down, the risk-on environment favors your strategy. Put/call ratio. If the ratio is extremely high, greater than 1.0, the market is overly bearish. A sudden ORB breakout could be a powerful short squeeze. Comparison: standard versus high probability filter. Feature: standard ORB, high probability ORB. Reduced alerts. Liquidity: any volume, dollar volume, greater than $100 million. Market: ignored. Stock and SPY both greater than VWAP. Momentum, not measured. TTM squeeze is firing. Cyan. Trend. Price action only. ADX greater than 20. Strong trend. Outcome. More trades, approximately 45 to 50% win rate. Fewer trades, approximately 60 to 70% win rate. Applying this to your S-Corp routine. Since you only trade from 9:45 a.m. to 10:30 a.m., you don't have time to look at 50 charts. You need these indicators to talk to each other in a single watchlist column. A golden alert for your system would look like this. 1. Time, 9:50 a.m. 2. Dollar volume, already at $40 million, on pace for $200 million plus. 3. ATR range is currently 55% of daily ATR, high relative move. 4. Sentiment. SPY is green and above VWAP. 5. Momentum TTM squeeze just shifted from red to cyan on the 15-minute chart. If you filter for all 5, you might only get 2 to 3 alerts per week, but your confidence in risking that $320 will be much higher.